Mortgage rates are pretty high right now. What can I do to get a lower rate? Well, I've got 8 strategies you can use to secure a lower mortgage rate. Mortgage rates certainly haven't done what we hoped they would do and stay at the historic lows that we saw in the past couple of years. And the current climate has been really unsettling for both home buyers and sellers. But with proper planning, you can work towards getting the lowest rate available today and open up the possibilities of refinancing to a lower rate in the future. But before we get into the 8 strategies, let's take a look at what a 1% difference in your interest rate means and how it can save you money. According to Trading Economics, the average mortgage in America is $410,000. Let's compare 6% versus 7% fixed interest on that amount over a 30-year term. With a 6% rate, your monthly payments will be about $2,458. At 7%, those payments would jump to about $2,727. So around $270 more. Now, if we look at interest over that same amount of time, you'll see a difference of about $97,000 over the lifetime of the loan. In other words, shaving off just 1 percentage point on your mortgage could put upwards of $100K back in your pocket over time. Now let's dive into some of those strategies. The first strategy is to raise your credit score. Buyers with higher credit scores are seen as less risky, and lenders tend to offer them lower rates. A good credit score typically starts around 690 and goes all the way up into the 800s. If your score is low, take the following steps to improve it. Correct any errors on your credit report that might bring your score down. You can get a free credit report at annualcreditreport.com. Pay off all your revolving credit. Those are your credit cards and maybe your home equity line of credit. Avoid closing old credit card accounts that are in good standing. It could lower your score by shortening your credit history and shrinking your total amount of available credit. Make all your future payments on time. Payment history is a primary factor in determining your credit score, so make it a priority. Limit the number of credit applications you have to avoid having your credit score take a ding for too many inquiries. If you're shopping for a car loan or a mortgage, make sure you minimize the impact by searching within a finite or a short period of time, like maybe 2 to 3 weeks at the most. Over time, you should see your credit score start to rise, which will qualify you for a lower mortgage rate. Number 2, keep steady employment. If you're preparing to purchase a home, now might not be the right time to make a career change. When you apply for a mortgage, the lender is going to take a look at your employment and income for the past 24 months. If you're earning a steady paycheck, you could qualify for a better rate. A stable income history gives the lender more confidence in your ability to pay back the loan. Having a job change doesn't automatically disqualify you from purchasing a home, but making a shift from a W-2 to a 1099 income could throw a wrench in the works. Number 3, lower your debt-to-income ratio. Even with a great job and a high credit score, a lender will become concerned if your debt payments are consuming too much of your monthly income. That's where debt-to-income ratios come into play. There are 2 types of debt-to-income ratios. Front-end ratios are what percentage of your monthly gross income is used to cover your housing expense, the mortgage payment, the insurance, the taxes, etc. Back-end ratios are what percentage of your gross monthly income are used to cover all of your debts, your housing expenses, your credit cards, your car payments, student loans, etc. What's considered a good DTI ratio? To get the very, very best rates, lenders typically would like to see a front-end ratio of about 28% and a back-end ratio no higher than 36%. If your DTI ratios are higher, you can take steps to lower them, like buying a less expensive home or making a larger down payment. You can also lower your back-end ratios by paying down all your revolving lines of credit, and getting a boost in your monthly income will also affect or lower your DTI ratios. Number 4, increase your down payment. Minimum down payment requirements vary by loan type, but in some cases you can qualify for a lower mortgage rate if you apply a larger down payment. Why do lenders care about the size of a down payment? Well, because borrowers with a larger amount of equity in their home are less likely to default on their mortgage. That's why conventional lenders often require borrowers to purchase private mortgage insurance if they're putting down less than 20%. A larger down payment will lower your overall borrowing cost and lower your monthly payment because you're taking out a smaller loan. Just be sure to keep enough money set aside to cover closing costs, your moving expenses, and any furniture or any other items you might need to make yourself comfortable as you move into your new home. Number 5, compare loan types. All loan types are not created equal. The loan type you choose could cost or save you money depending on your personal qualifications and your circumstances. Here's a list of the common types of loans available today. Conventional. These loans typically have the best rates, but they come with much more strict credit and down payment requirements. FHA loans. They're backed by the government. They're a little easier to qualify for, but they have higher rates. There are specialty loans like VA and USDA loans, which you can qualify for if you meet specific criteria. And lastly, there's jumbo loans. These are loans that exceed the local conforming loan limit and are subject to stricter requirements and may have higher interest rates and fees. When considering loan type, you may also want to weigh the pros and cons of a fixed interest rate loan and an adjustable rate loan. With a fixed interest rate loan, like it says, the rate stays fixed for the term of the loan. These have been some of the most popular loans because they offer stability and predictability. Adjustable rate mortgages start off with a lower introductory rate than a typical fixed rate mortgage, but then rise after a set period of time, typically around the 3 to 5 year mark. An adjustable rate mortgage may be a good option for you if you plan on selling your home before the interest rate resets. However, life is unpredictable, so make sure you weigh the benefits and the risks involved with an ARM. Number 6, shorten your mortgage term. A mortgage term is the length of time your mortgage agreement remains in effect. Terms are typically 15, 20, or 30 years. While the vast majority of mortgage rate terms are 30-year, if your goal is to pay the least amount of interest possible, you may want to crunch the numbers on a 15-year or 20-year term. With shorter loan terms, the risk of default is less, so lenders typically offer lower interest rates. However, it's important to note that even though you'll be paying less interest, your monthly mortgage payment will be higher since you're making a smaller number of payments. So before you agree to a shortened term, make sure you have money in your budget to accommodate the larger monthly payments. Number 7, get quotes from multiple lenders. When shopping for a mortgage, make sure you get quotes from several lenders and lender types to compare interest rates and fees. Depending on your situation, you could find that one institution could give you a better deal on the type of loan and terms you're interested in. Some borrowers choose to work with a mortgage broker. Like an insurance broker, a mortgage broker will go out and gather quotes and find the best rates. If you decide to use a broker, make sure you understand how they're compensated and choose multiple brokers so you can compare their recommendations and their fees. Don't forget, I can also be a good resource to help you find a lender that best suits your needs. Number 8, consider mortgage points or buy down. Even if you score a great interest rate on your mortgage, you can lower it even further by paying for points or doing an interest rate buy down. When you pay for points or do a rate buy down, you're essentially paying the lender an upfront fee in exchange for a lower interest rate. The cost for a point is typically 1% of your loan amount. For each point you buy, your interest rate will be lowered by a specific amount, typically around 0.25%. You'll need upfront cash to pay for the points, but you can more than make up for the cost in interest rate savings over time. However, a rate buy down doesn't make much sense unless you're going to be in the home long enough to recoup the cost. You can determine the break-even point or the length of time that you'll need to keep the mortgage to make up for the cost by dividing the cost by the amount saved each month. This can help you determine whether or not paying for points or a mortgage rate buy down is a good investment for you. There you are, 8 strategies you can use to help secure a lower mortgage rate. Now, before I end the video, there's a couple things that I want to touch on in regards to the current market. Although higher mortgage rates have definitely made it more expensive to finance a purchase of a home, it's also eliminated some competition from the marketplace. So now today's buyers are finding more homes to choose from, less bidding wars, and more sellers willing to negotiate or offer incentives like cash for closing costs or a mortgage rate buydown. If you're ready and able to buy a home, there's no reason that concerns about current mortgage rates should sideline your plans. The reality is that many economists predict that home prices or home values will continue to appreciate. So you may be better off buying today at a slightly higher interest rate than waiting and paying more for a home in a few years. You can always refinance if interest rates go down, but you can't make up for years of lost equity growth and appreciation. If you have any questions or would like more information in regards to buying or selling a home, please just reach out to me. Also, please check out the description for your free download of a home seller or home buyer's guide. And as always, please make sure you hit the like and subscribe button for me. I'm Brandon Pettis. See you in the next video.